Good morning. Welcome to Commodities Unplugged, a month-long series of webinars organized by the Singapore Exchange. I am June, your host for today. So today, we are delighted to have with us Andrew. He has worked in the Asian energy markets across power, gas, coal, oil, and retail for 19 years in various roles. For 10 years, he worked at Origin Energy in Sydney, initially as a spot trader, then as a derivatives trader. In 2011, Andrew moved to Singapore to help initiate the Castleton Commodities International expansion into Asia, building an Asian energy trading business from inception. This involved wholesale and trading, asset due diligence, and also retail opportunities. He is now the Chief Commercial Officer of Jade Energy and also the co-founder of iSwitch Energy. Jade Energy is a pioneer of electricity trading in Singapore and has also been involved in exchange and OTC traded market since 2015. Today, he will share more with us about the Singapore power market. So over to you, Andrew.
For hosting the series of webinars, I think it helps us to maintain a level of personal and educational growth when attending live seminars just isn't possible at the moment. Today, I'd like to take you through the journey of probably the last 5 years of the Singapore power market. It's been an amazing journey, huge development, and we'll also talk about what the future holds. There'll be a brief introduction on Jade and iSwitch and why we trade Singapore power, why we chose Singapore to build a retailer. We'll talk about some developments in the market, types of participants, the risk. Important to highlight that in Singapore, the risk isn't just electricity, it's also oil, because it's a heavily oil-linked market. We'll talk about electricity trading, the future of the market, and a summary of the opportunities. So we've got a pretty busy morning, roughly 1 hour ahead of us. Hope you've got plenty of coffee. So RCMA Group is a commodity trader, global commodity trader, trading rubber, cotton, coffee, sugar over the years, and RCMA Energy was born out of that in 2015. RCMA Energy then became Jade Energy, and Jade owns iSwitch. We also own a small oil field in the Perth Basin, which we're currently producing, and have entered farming agreements with the likes of Medgasco and Vintage, and that's in Western Australia. So some exciting things happening there in the Perth Basin. In Singapore, iSwitch has just over 100,000 customers, and we aim to be a modern energy retailer where electricity is only the start of the conversation with our consumers. We're the third largest electricity retailer in Singapore with just over 100,000. We're also the largest green energy retailer in Singapore. We use VCUs and other United Nations registered carbon credits to offset the metered electricity usage of our customers. It's a voluntary scheme because Singapore doesn't have a mandated offset scheme similar to Australia or what you might see in Europe. However, a carbon tax does exist in Singapore, and that nets back to roughly $2 per megawatt hour. In Singapore, iSwitch trades various Asian power products, oil, gas, renewables, and it's important to highlight that surrounding countries are also looking to open up and to liberalise and create a wholesale, traded and a competitive retail environment. Malaysia is likely to go next. I think Philippines undergoing that process as well. It's inevitable that that will continue through the rest of Asia, I think. iSwitch embraces technology, and it's significant. It's a significant focus across all energy participants to embrace technology and to have a robust IT platform that enables you to plug into other systems and to take advantage of other market developments. On our mind, for example, is battery and electric vehicles, for example. So obviously a very exciting area, but we need to think about how can we connect our consumers to those things, and obviously IT and various platforms are quite important. To achieve that, we're quite focused on strategic partnerships. Retailing is very much an on-the-ground kind of business. As you can see the photos, we win our customers digitally, but we're also on the ground doing the face-to-face reselling. In our B2B business, we host a number of various events, and it's really interesting to hear what those customers tell you. It's important to remember that this liberalisation process has really only just begun in Singapore over the last few years, whereas in Europe or Australia, it's something we've been doing for 20 years. So a lot of consumers, both the big end of town all the way down through to the coffee shop owners, really want to know what it means for them and how can they take advantage of it. So being able to connect with them through movie nights like this is a really fantastic opportunity for us to keep our ear to the ground. So let's get straight into power markets and the details of power markets. You typically have a financial market which interacts with a retail market. The introduction of exchange-listed electricity futures on the SGX provides a marketplace where various market participants can come and lay the risk off to each other. We have an OTC market, which is bilateral off SGX marketplace. It's quite small at the moment, but I have to say I'm encouraged since the beginning of last year that is building. We have a number of ISDAs, for example, and we trade with Gencos and are starting to do more and more structured products. I'd probably compare it, for those Australian power traders out there, I'd probably compare it to Australia in around about 2002, where you had a number of Gencos just dipping their toes in the water, and then very quickly it exploded to being a fully fledged OTC, large volume futures market, which is very exciting. We have a number of speculative traders globally who are now involved in the Singapore power market. I think some of those are attracted by the oil and gas component that the Singapore power market enjoys, and I will touch further on that later. So you end up with a pretty volatile wholesale market, partially driven by oil volatility, as well as the electricity fundamentals, and that's what drives the financial market. Over on the retail market, you have many new retailers who have entered the Singapore power market. Probably up to 30 retail licensees for a country of 5.5 million people. However, you really only have about 8 or 9 regular participating retailers. The others are a handful of niche players. Maybe they're focused only on solar or technology development. So this process for the end consumer has resulted in a number of broad retail offerings. They're no longer doing or thinking about things the way they used to. And that's a major benefit of a liberalised market. It's resulted in significant price reductions, probably a further 20% price reduction than what the price was around about 3 or 4 years ago. So it's a major benefit to community. With that, you get industry growth, you get manufacturing, because when you have lower energy prices, it attracts manufacturers. For example, a lot of you may not know this, but Singapore is a huge producer of semiconductor components. I think the largest consumer in Singapore consumes an equivalent flat load of 200 megawatts in every half hour. So 200 meg of flat load. That is extraordinary. I think, to my knowledge, the largest consumer in Australia would be the gold mine, from memory, and that's about 120 megawatts. So for a country so small, we certainly consume quite a lot of manufacturing energy. And that, of course, creates new jobs, metering, IT, etc., etc. Retail contestability in Singapore is referred to as the open electricity market, and it definitely has resulted in low retail prices. Let's touch on hedging and risk management as well. We have a physical market which interacts very closely, and risk management with the financial market. And risk management is a critical component for the survival in a volatile oil and power market. This is why the SGX market is such a valuable cornerstone to the whole Singapore energy ecosystem. It's a half-hourly settled physical market. Generators rebid in a similar manner to Australia and New Zealand and Europe, settled on a 30-minute basis. Government regulated and controlled, and they do an outstanding job. And when you consider what has been achieved in only the past 5 years, the establishment of a futures market, the full liberalisation of the market, I think it's safe to say Singapore achieved in the last 3 to 5 years what it might take 20 years for most other countries to achieve. and that's through a highly consultative framework, which it's a real example of a pretty reliable system. In the physical market, to be a participant, you must own a physical asset. Many participants like the Singapore power market structure because you don't need an asset to take part. However, obviously, there are the large asset owners who continue to maintain their assets. And of course, in the physical market, you'll have those generator assets, retailers, transmission owners. All transmission is owned by the government in Singapore. And a very important component is also the fuel providers, meaning LNG and the piped natural gas that comes from Malaysia and Indonesia. Over in the financial market, we trade using predominantly CFD and futures contracts. OTC structures provide you with non-baseload and maybe something a little bit more creative to help you manage your risk. As I mentioned, no need to own a physical asset to participate. And you have a broad variety of participants in the financial market, including the generators who hedge, retailers who hedge, banks, commodity funds, hedge funds, etc. So when we trade electricity, what we're trying to achieve is we're dealing in a financial contract which will enable the trader to speculate on and to manage the risk of the volatile wholesale market. So a speculator typically doesn't own a physical asset, whereas someone who is managing a position is someone who does have a foundation position. What I mean by that is a retailer will have a short position, and they need to trade electricity to try and lock in that margin and exchange the uncertainty and the lack of predictability in that market in exchange for a certain retail market margin. And so it's all about shedding your risk, passing that risk on to somebody else, perhaps finding a participant that has a corresponding risk to you, and then you share that risk to provide both of you with certainty. Some of the elements to consider in power trading and how they relate to Singapore, I'll begin with demand. It's reasonably stable in Singapore. The weather is, other than the storms, I think the weather is quite predictable. The definition of a very hot day would probably be 34 degrees with a feels like 38. So daytime would range between a feels like of sort of 32 to maybe 38 due to the humidity. And then very rarely do you get temperatures below 28 during the day. So peak demand, you end up with around about somewhere between 6,500 megawatts in the daytime peak up to about 7,100, maybe 7,200 would be the definition of a high half-hourly demand. Supply market, there are some important considerations when trading electricity. In Singapore, short-term and long-term are critical, obviously short-term due to the 30-minute pricing structure, but also Singapore is very good at planning forward how much supply will be needed in the next 3 years, 5 years, 10 years. So understanding the firm versus intermittent type of supply is very important. Singapore is about to undergo a very significant increase in solar. So Singapore has committed to reaching 350 megawatts of installed solar by 2020, and that was achieved. And to be honest with you, if someone said that to me about a year ago that we would achieve that, I would have said that's very unlikely. But there was a very strong push over the past 12 to 18 months to hit that target, and great to see that target was hit. And now we have a target of 2,000 megawatts by the end of 2030. Very ambitious target, but it's Singapore, and Singapore's pretty good at achieving its targets, that's for sure. That will bring grid upgrading, grid technology ideas, perhaps some battery. I read recently that Singapore has also committed to 200 megawatts of battery installations by 2025. So certainly opportunities for all global players all through the supply chain. We spoke about weather, so I won't touch on that too much. Transmission is owned by Singapore Power. Although some bottlenecks do occur, they're quite rare. The last one that comes to mind for me, I think, was Q116. A lot of the power stations are based on Jurong Island, and so there was some improvements done to prevent the bottlenecks coming from Jurong Island. But again, unlike Australia, you probably don't get that many transmission constraints here in Singapore. Credit risk is becoming a more important environment as you get that oil market fluctuations. We've had some major defaults in the oil markets. Fortunately, I don't think it's flowed through too much to the electricity market, so we're relatively unscathed in the electricity market, and that's due to good regulation. Generator fuel is probably, if not the most important component, it's got to be up there, mainly because of the amount of gas that's imported, and that's what drives the short-run marginal cost. So in Singapore, we have around about 97-ish% of CCGT. A large component of that is driven by gas, which is imported from Malaysia and Indonesia, linked to high sulfur 180 index pricing. And the rest of the fuel is LNG, and that includes spot cargoes. And spot cargoes have become a very important factor and have depressed the Singapore electricity price quite significantly. And given the virus and given JKM at around about $2, spot LNG cargoes are likely to depress the Singapore power market in the near future. And that will also create additional take or pay gas opportunities. So generator fuel, take or pay gas distress, hardly an opportunity. So generator fuel is a very important component to analyse. In power markets, we have structured products. So the SGX has listed a flat baseload product, but retailers like iSwitch, for example, also need a bit of peak. And so we deal with various players in the market who will sell us what we need to de-risk the book, in particular the peakiness, the peaky shape of the book. So having those relationships is quite important for us, and we value them very, very highly. Government relation and regulation we spoke about, and again, it's a pleasure to be dealing in a jurisdiction that's so transparent. The types of participants that we see are obviously the generators, and their objective is to lock in a margin and to perhaps de-risk forward cash flows. It makes it difficult at this point in time because there is a take or pay gas problem in Singapore, and so it's probably a difficult time to be a generator in Singapore. As load does grow, which it does in Singapore, we would hope that that gets alleviated. Generators need to manage their fuel costs, and so they hedge the oil component of their fuel. And so you get this hedging regime, which is based around oil as well as electricity. Retailers tend to also look to lock in a margin and to de-risk their business. Large users have the choice of taking spot market exposure. And don't forget, it is a volatile spot market with the cap and floor being at around about negative $4,500. But typically large users will source their hedges from a retailer, and then the retailer will lay that risk off onto the futures or to generators or to traders who take that risk that the natural players don't want to take, and then they'll speculate on that position. So we have a growing interest from various international financial participants in Singapore, which is great. And don't forget that Singapore is the home of a lot of large commodity houses and traders anyway. So I think that certainly helps the Singapore power market. It's a very dynamic oil-linked market. It's a real pleasure to trade. Can be a challenge to trade as well, but it forces you to look at oil markets as well as electricity. It's linked because all of the gas that the generators buy is linked one way or another to international oil markets. So the global oil markets will drive the short-run marginal cost for Singapore Gencos. Those oil markets will be setting the Singapore power tariff for B2C as well as the B2B markets. And then that flows through to how correlated the SGX futures market is and the spot market to those oil markets. And I have a graph on which highlights the high level of correlation in the futures market between oil and electricity. People like the electricity market because it brings multiple margin opportunities all the way through the value chain that other markets may not bring. For example, there is a role for battery, huge role for solar, huge role for upstream gas providers, demand side management. I think it's safe to say that Singapore's probably taken some of the best components of other markets and brought it all together. And yes, you could make the comment that, well, that's easy for Singapore to do because it's such a small place and has so many traders and easy to build infrastructure. But the fact is we end up with a market that does carry significant opportunities for a variety of different players. We touched on LNG spot cargoes, which we do believe will become a larger factor simply because the economics are so overwhelming at the moment. And having any gas flexibility is a really positive thing to have because then you're able to blend that with your retail load, and the retail load becomes a bit of a price floor perhaps for your gas. So there's a new word around town which may not be so new to some of you, but a gas sink. So Singapore becomes a good place for you to sink your cheap gas and be able to take some of that cheap spot gas. Some of the tools for hedging in the Singapore power market and other power markets, in fact, are your derivative contracts, which we spoke about already, SGX listed, swaps. Option markets probably aren't that big just yet in Singapore, but it is inevitable that options will become a major component. Spread trading, the fuel versus power, is quite a significant component in this market. So, for example, you could buy your electricity contract on the SGX, for example. You could buy your Q421 and then you could sell your oil against it and be left just with the electricity component. So you've stripped away the oil risk. Environmental considerations are becoming more and more focused in Singapore as we've brought in the carbon tax, but also COP21 commitments and a solar target will ensure that sustainability become a larger focus and the end consumer starts to think a bit differently. As I mentioned, iSwitch is the largest green retailer and we use international carbon credits to offset our customers' retail load. It was a very tough conversation, I have to say, around 2016, 2017, having that carbon conversation with the end consumer. But it's without doubt, in the last 18 months, sustainability and carbon have become a very hot topic in Singapore. So for Singapore to have a 2,000 megawatt target by the end of 2030, that's ambitious, but with that will come complementary technologies such as batteries. It's already a CCGT heavy market. Maybe we'll see some OCGT or some fast start diesel units come around perhaps to help manage with that grid variability. But the environmental considerations are definitely becoming quite significant. The oil market risk we've spoken about. PPAs probably relate more to solar. There are some large solar deals that are getting done. The Public Utilities Board launched a roughly 50 megawatt floating solar project, and that was won by Sembcorp very recently. So Sembcorp will be building 50 megawatts of floating solar on one of the very large reservoirs that Singapore has. That's very exciting. And that's what we all love about Singapore, very, very futuristic, very exciting place, not afraid to try new things such as floating solar on a very large scale. The spot market itself is also a tool for hedging. Data quality for analytical purposes is quite good. And so I have to say probably not as good as Australia. You don't get the granularity of the rebids at 4 a.m. like you would in Australia. But nevertheless, the opportunity to improve that certainly exists. This is the Q1 21 SGX electricity futures contract against the DEC 20 in Singapore dollar oil correlation. Green is oil. So you can see the correlation is extraordinary. And then that can probably be said for most contracts. Singapore lists on the SGX, there's 2 years forward plus 1 quarter of electricity contracts, and they're all obviously correlated to oil. Our friends at Diamond Energy produce a off-the-shelf analytical tool called Nemsview. This is a snapshot from a few days ago. You can see a very depressed electricity market. The price for the day was $39.53 at the top in the middle there. And that's partially driven because of the lower demand from the COVID-19 situation that we find ourselves in. I think demand is probably down 10, 15%. And so we end up with quite a depressed electricity market that probably is not expected to recover for some time. So this is an example of the analytical tools that are available for us to use. The energy market company, the EMC, releases a lot of the raw data, and then we're able to turn it into things like this or to build your own analytical tools using that live data. This is the quick snapshot of the Australian spot market to put a few things into perspective. We mentioned the volatility in Singapore can range between negative and positive 4,500. I've also used this to highlight the impact of renewables and how they need to be managed. This is a snapshot from a day when South Australia went to $14,000 and found itself islanded. And I think Singapore regulators do spend a bit of time talking to Australian regulators to help understand how do you get the mix between the right amount of renewables, meeting your sustainability commitments, but without putting your grid at risk. Let's delve a little bit deeper into the Singapore market structure. Singapore has about 5.5 million people, 1.4 million households, and so you do get a very heavy skew towards apartments and condo living. I think around about 6 or 7% of dwellings are landed houses, so obviously a very significant apartments living share. However, average domestic consumption is around about 6 megawatt hours per year. So let's have a think about that for a second. In Australia, I think it's roughly around about 5 or 6, depending on where you live. And most Australians live in houses. So when you consider that Singapore is very heavily weighted towards apartments, those apartments are using a significant amount of energy, similar to an Australian household. So you end up with quite a significant retail load. And certainly when iSwitch started, we didn't expect to hit 100,000 customers. And now we've ended up with a significant retail load. And as we get to know our consumers a bit better, the impact is obviously air conditioning. As a country, Singapore's annual consumption is over 50 terawatt hours a year. That's made up probably 65% of that is manufacturing, C&I and B2B type of load. There are now some very large data centers in Singapore, and that trend will continue to grow. So data center load is very large. The semiconductor load that we spoke about is also quite large. And so Singapore has pitched itself as a real manufacturing hub with low-priced energy. So that load of 50 terawatt hours will grow. We mentioned the solar ambitions. You've probably read about a project called Sun Cable, and that's a project where which has found financial backing to do a study into building a solar cable from the Northern Territory all the way to Singapore, the very significant amount of electricity. iSwitch has signed up to be, or about to sign up to be, a foundation off-taker for that project. So we're very excited about that. And should that project go ahead, it will enable Singapore to diversify even further its energy usage. So we're in a regulated market managed by the Energy Market Authority and the Energy Market Company. Very strong framework with a high level of consultation across the whole industry. Grants towards batteries, grants towards technology, a real feeling of let's push ahead and let's improve our grid let's improve the way we do things. So it's a real pleasure to do business in the Singapore energy markets. And we've ended up with a very vibrant SGX listed futures market. There are paid market makers since middle of 2015. So the opportunity to lay off your risk is always there, and liquidity is quite high now. It's a very impressive market, trades a lot every day. Similar market structure to Australia when it comes to metering. You have the power stations and the physical grid on the left flowing through on that picture. And then you have what you'd call probably the wholesale and financial market, where retailers are required to buy from the spot market. Electricity generators are required to sell into the spot market. And then all of that is managed by the regulator and power grid, which is SP, Singapore Power. The liberalisation process started a long time ago with just the large customers being released into the pool of contestability. But it really took off around 2015. And that's when the small 2 megawatt hour, maybe 200,000 odd businesses became released for contestability through the most recent rollout, and then 1.4 million households. What I find really interesting is in that first 12 to 18 months, which, probably middle of 18 all the way through to now-ish, roughly, half of the market has moved away from the incumbent. Now, you could say that's fantastic. Half of the market churned away and embraced liberalisation. Now, you could also say, well, there's still a lot of meat on the bone there for retailers because half of the market is yet to churn. And so the opportunity, we feel, is still very, very strong to continue to grow market share and for either new entrants or the incumbents to get involved as a trader or a facilitator or batteries or solar, and to carve out your own niche in this contestable market. So the phased liberalisation has been very successful in Singapore with a very stable outcome. So let's spend some time talking about the future of this market and where it's headed. There's a lot of work that the EMA does on development, a lot of consultation with the industry. And bear in mind, the industry means not just retailers or generators, but also IT platform providers, gas producers, Shell, Pavilion, infrastructure players. There's a huge range of participants in this market. And so where we're currently headed is the oil continue because it has to continue. Singapore imports all of its gas for the generators. And so we expect a larger OTC and structured hedging opportunity. In James Whistler's presentation from SSY, he mentioned the need for peak electricity futures to be listed on the SGX, and we certainly echo that. It would be good to see additional products and maybe even options listed on the futures. So we expect to see less long-term LNG contracting, and that's probably going to happen around the world. Not only in Singapore, and you'll get additional spot cargo flexibility. Singapore is also currently investigating the need for a capacity market, which will encourage new forms of generation to be built and should help with more grid stability. We will obviously get more renewable offerings. Singapore is very focused on a smart city, smarter future. So the next 10 years, the grid will need to accommodate significant solar, significant battery, and additional load as more manufacturing and data centers get built. What we ask ourselves as a retailer is, how will the home consumer behave? Will they embrace home batteries? Will they embrace the electric vehicle momentum that will inevitably occur? And how will this play out in the home? Will I be able to drive my car into my house, plug it in, and then a central monitoring system manages all of that? iSwitch is currently investigating virtual power plant possibilities with some players out there, because we do think that that is the way that this is all headed, not just in Singapore, but globally. So domestic batteries and VPP opportunities. I understand that that's already happening in Australia, but I think it would be new to Singapore, and that's something that iSwitch is quite excited about. Singapore is a great place to be a test bed for smart grid development. As we mentioned, electric vehicles, the metering, AI. The EMA has a regulatory sandbox which they can carve out for players to test their technology, and certainly people embrace that, and that's, I think, what makes Singapore a great place to build a business like iSwitch and to be involved in electricity trading. And then, of course, the bundling of new products with electricity, and you end up with a multi-service platform. So electricity retailing gets you into the household, and then there's the opportunity to ask yourself, what else can I do to strengthen the relationship with my customer? Insurance, home services, all of these additional offerings. Telcos are obviously looking at these sorts of things all around the world and building relationships with electricity retailers as well. And so the future in Singapore is retail, and it's very much digital. Domestic and business solar, so there are large-scale solar opportunities as well as domestic. You have a battery and EV opportunity which will only grow in the coming years. We mentioned the relationship with insurers and how in Singapore there's a very large insurance culture. And one of the perks that we give our customers at iSwitch is a free personal accident insurance if you sign on. So they're the sorts of ways that we're looking to broaden our business and move into growing our market share, which increases our need for trading of that electricity to manage our risk. We mentioned home services, and then all of these things get billed into your monthly retail bill. We spoke about empowering the consumer both in the business and in their home. And so when you build an app and you try to increase your customers' empowerment, we think about automation, and maybe when prices are high, the customer reduces their usage to try and manage their bill. That's also good for the grid owner. And so Singapore is constantly investigating how do we reduce the need to spend money on the grid and instead learn to manage the load through demand-side management a bit better. And when you consider that some of the manufacturing load is very significant, there is a strong and obvious demand-side management opportunity which can work in concert with the capacity market. Before I touch on this, I might just have a look at the questions that are coming up, if you just bear with me. So one question is, how likely do you see Singapore importing solar power from Australia? The Sun Cable project, and I think there's even another project out there, they are obviously ambitious, but there is a lot of money being spent on this. I think that contracts are being signed to do the mapping, the underwater mapping. So this is far from a pipe dream. Obviously, it won't happen in the next few years, but it's something that could happen by the end of 2030, and it would help reduce Singapore's reliance on oil markets. If not from Australia, then it's possible that solar farms will be built Malaysia or other countries that surround Singapore, assuming the land is available. So importation of solar power, I think, is a likely outcome, whether it's from Australia or elsewhere. Another question is, do you expect the pricing basis to change to a gas benchmark anytime soon? That is a really good question. At the moment, it's all linked to oil because these contracts are long-term contracts. I assume some of them will roll off over the next 5 years. And then I would expect that, yes, they would start getting linked to international gas benchmarks. So my answer there is yes, I certainly would expect that to happen. Another question is, has there been a shift away from high sulfur 180 as a reference price as liquidity in this product has dropped off? Is Brent replacing it as a reference price? I think that they both still play a major role. I don't think you can still focus on just one of them. So they are equally important, but what we find is that timing is quite important. So suddenly, when you have a spot cargo that gets brought into the market, you might lose some of that correlation that you would have otherwise had. Liquidity in high sulfur 180 may have dropped, but the fact is, it's likely that these contracts are still linked to that index, regardless of whether it's liquid or illiquid. Another question: how does one go about purchasing carbon credits, which are internationally recognised in Singapore? So that's quite a good question. It's a heavily brokered market. So similar to Europe, you would use a broker to purchase carbon credits or build a direct relationship with a asset owner, maybe a wind farm owner, for example. Singapore has a large mix of customers. Some of them are happy with voluntary credits. Some of them are RE100s, which are committed to purchasing a very particular type of benchmark of credit, which would be more expensive. And so what we do in iSwitch is that we tend to buy some of our carbon credits from a wind farm in northern China. We like that particular wind farm because when those wind farms operate, they back off brown coal. Now, brown coal tends to be at a carbon intensity of much higher than black coal and probably one of the dirtiest forms of coal. So that's why we're attracted to that particular project, because we help fund that project and allow them to reinvest that money to build more wind farms in that area. Another question is, what do you think about the interconnection agreement signed through ASEAN to supply renewable energy from countries such as Laos to Singapore? So that's probably something that might occur towards the end of 2030, and I think so my personal opinion is that what will drive that is COP21 and sustainability commitments. And being able to achieve that will require some significant capital investment from those countries. At the moment, Singapore is pretty self-sustainable and self-sufficient when it comes to energy security, or at least building towards that. There are more LNG terminals for storage being built. There's obviously about to be a huge solar increase, the battery component, the opportunity for solar farms in surrounding neighbours rather than all the way up that chain through ASEAN. So I think it will happen, but it's very, very hard to pick exactly how this will happen. There's a few questions here on the capacity market. I'd love to speak more about it, but at the moment, I think EMA are still trying to work out how that will look. So in regards to the capacity market, I'd probably have to refer questions to the EMA on that, because it's still being developed. As I move to this slide, which talks about international fuel linkage and power trading, the Singapore market provides cross-commodity opportunities, and they're great opportunities. Power versus fuel, solar investments. You end up with adjacency across multiple business units. So if you're a large company who is already trading gas, already trading oil, and you just rely on one type of hedging, be it futures, then I would certainly encourage you to talk to electricity retailers and maybe look to link with them, because they may have a similar risk to you. And so that provides a cross-commodity opportunity of gas versus power. But understanding the fuel mix of the market in which you operate is quite important, because suddenly you'll see whole new opportunities that others may not see. LNG is a critical factor in Singapore. For some people, it's a transitional fuel, for example, towards a renewable future. That renewable future takes a long time to build, and LNG will act as that stabilizing, as that grid stabilizing fuel, because LNG generators, OCGT or CCGT, can ramp up reasonably quickly or very quickly to be able to help balance the grid. So the linkage of LNG to power trading will continue. In fact, it's likely to grow. US gas and Australian gas is looking for a home, and that's provided spot gas opportunities in the recent future and throughout 2020. we expect that theme to increase. And gas could even provide a narrowing of price between countries, because you might end up with a gas-driven short-run marginal cost, not just in Singapore, but across other countries that are looking to move away from coal and into gas. So you'll have a correlation not just in Singapore, but also around Singapore's neighbours. Carbon markets have become quite important in Singapore as we look to reach our COP21 commitments. Some people think that carbon suddenly becomes a global equaliser because it will penalise high carbon intensity and it will reward low carbon intensity. And maybe that's right, but that's a slow journey. It will happen, but it's a slow journey. But it's certainly one which drives investment decisions and understanding the value of carbon credits. Because, for example, in Singapore, if you're a renewable solar player, you'll be getting paid the uniform spot price or futures price if you hedge, but you'll also be receiving a valuable carbon credit. So trading power in Asia, just to take the focus off Singapore for a minute, a variety of definitions exist. Philippines is a fascinating opportunity. 100 million people, yet installed capacity is still less than 15,000 megawatts last I looked. That is a market which is demand influenced. They do have weather variability, which does drive demand. So you end up with quite a volatile market. 3 different islands, main regional centres, call it. Malaysia looking to liberalise and go down this process. Huge country, big opportunities. And then you get these opportunities in different parts of Asia. So it's certainly worth thinking about how can I expand into these parts, especially if I'm a gas player, especially if I'm an existing retailer, and how can I deploy my existing technology and my platform into these new markets so I can scale up my customer base. We need transparency, and that's why we like Singapore. And then as data becomes of a higher quality in other areas, that will certainly attract traders and other investors. Carbon linkage across Asia, we spoke about that already. And having an exchange traded product allows investor to see a 2-year or even 3-year forward curve in their decision-making process. That's why having the SGX certainly helps consumers, retailers and generators and banks and financiers to get a gauge of what the price of power will be over the next 2 years. And so you end up with no one single trading method. You need to be on top of OTC and futures and PPAs and understanding how that whole energy ecosystem operates. I'll just go back to having any more questions. Could you elaborate more on your expectation of the transparent power spot market? Do you mean more data availability or anything else? So I am referring to granularity of data and data availability. Specifically in Singapore, I'm probably referring to outages. What time did a unit drop off rather than a unit dropped off today? So looking for that information. So at the moment, the data that we get tells us that, hey, this unit 4 from this participant turned off. But as a trader, it would be nice to know it turned off at 4 p.m. and then it became available again at 10 p.m. So using the time granularity of that data would be very helpful. And of course, as solar starts to play a larger role, it would be good to have some live solar data. I understand we do have that already, but import versus export as well would be very helpful. I mean, yeah, as a trader, the list of analytical requirements, I can sit here and talk for hours about that. Gas import, it would be good to see gas volume data, how much gas was generated, et cetera, but obviously there is a limit to what can be provided when it comes to transmission flows, often due to security reasons. June, can I ask how we're going for time? I've got one more question that I can see, 1 or 2 more questions.
Yeah, no problem. I think we have sufficient time to complete the questions.
That's great. Another question is, how do you predict demand with weather forecasting, especially for Singapore? What are the challenges and mitigations? But demand, so we as a retailer, we do receive data on how our consumers behave. So we can draw conclusions from our 100,000 residential customers. And I think the COVID example is probably a good example of understanding how demand would play out in May, June, July, back when we were in March and April. So we were analysing our customer data, and we were already seeing a very strong increase in domestic use. And that's because obviously everyone was working from home. However, we were also seeing a very significant decrease in our B2B load. And that's because the restaurants and manufacturing were forced to either close or to operate differently. So that wasn't really weather related. But when it comes to the weather, I have to say it's not really that variable. It's not really a weather-driven market. In Australia, it certainly is a weather-driven market. You do get solar at 6 p.m. turning off quite sharply. And that's something that Singapore will need to consider. What happens at 5 or 6 p.m. when it clouds over and the sun goes down and suddenly you've lost a few hundred megawatts, if not 1,000 megawatts of solar that was generating, and suddenly you lose it over a 1 hour period. So weather considerations are very important in the supply and solar market. But when it comes to retailing, again, it's quite a narrow range. It's not a heavily influenced heat or humidity influenced market. Obviously, it is a little bit, but the overwhelming price influencer would be short-run marginal cost and generator availability. Another question is, how will imports of energy affect the electricity market and the forward capacity market? So again, the forward capacity market is still being developed, and there's still a long way to go. EMA is working very hard and working closely with the participants and consultants to try and structure a market that is transparent and fair, but still encourages and rewards investment. So every country needs investment. And the forward capacity market encourages investment. And through that, you get paid to be available, you get paid to build. But again, anything to do with the forward capacity market, it's just too early for us to comment, and I would have to refer any comments back to the EMA. So June, I think that brings us to an end. Again, I want to thank the SGX for putting this together. I'd also like to thank all of you at home for tuning in and listening to me rambling on about what's happened in the last 5 or so years in what's been a fascinating journey and one that we've really enjoyed working with the other market participants.
Right. So thank you again, Andrew, for all your sharing today. It has been really insightful. Please join me in thanking Andrew for his sharing today. We have come to the end of today's webinar. We also thank all attendees in joining us for the webinar session today. Finally, we would also like to thank our sponsors for their generous contribution to SGX Blue Charge. Please join us at our next Electricity webinar today at 2 p.m. See you there. Thanks again, Andrew. Thank you.